Good morning, everybody. Just by way of introduction, my name is John Jones, and I'm a director in corporate and international tax at RSM South Africa. The purpose of this webinar today is to have a look at the changing transfer pricing environment, to discuss initially some of the changes that have been brought into the legislation from a South African perspective, and to consider some less direct transfer pricing changes to the legislation, but more indirectly associated to the transfer pricing and cross-border transaction world. So as a starting point, what I wanted to deal with is just start once again with the fundamental principles of transfer pricing. And in particular, just as a starting point, to look at what are the sources of information when we're looking at transfer pricing. And the first of these is obviously the national tax legislation. From a South African point of view, we obviously have specific legislation that deals with transfer pricing. The second is the OECD, and specifically the transfer pricing guidelines for multinational enterprises and tax administrations, or what are more commonly referred to as the TP guidelines. But in that context, it's important to note that South Africa is not a member of the OECD. We are an observer, but our practice is to apply the OECD TP guidelines. So the OECD TP guidelines become very important as a point of reference when considering transfer pricing from a South African perspective. So flowing from this, where do we start? So firstly, we need to understand the legal system of the country or countries in which you are operating. And I think what is important is that concept of countries. Remember that anything transfer pricing related by implication is cross-border. And that means that you're operating within multiple jurisdictions. So you cannot just work on a premise that what is in your local legislation is going to be adequate within any of the other jurisdictions in which you're operating. And so this becomes a multi-jurisdictional type exercise, and you need to ensure that you've got appropriate consultants within those various jurisdictions that you are operating. Then we look at the specific transfer pricing provisions that are in the legislation. And those will set out the fundamentals. Flowing from that, there may or may not be regulations, which are in addition to the base legislation. So again, from a South African perspective, our legislation is within the body of the Income Tax Act, but we have a number of regulations which are external to the Income Tax Act, which in particular set out the record-keeping requirements. Then we also need to consider case law. And then if nothing else, there is anti-avoidance legislation, which may or may not apply. And then there may well be additional administration specific to administrative issues around the transfer pricing components. And then as a final point of reference, you may be required to look at the constitutions of the various jurisdictions you're operating in. And then very lastly, we need to consider the impacts of the double taxation agreements because those obviously are important. Again, we're dealing cross-border, we're dealing across multi-jurisdictional environments, and you need to then consider whether or not you have DTAs in place, which may or may not defend specific positions that you take. From a transfer pricing point of view, there are three fundamental requirements for transfer pricing legislation to be of application. The first of these is, as I alluded to a little earlier, that transactions must be cross-border. So they have to be between a resident and a non-resident. And this is where we need to consider the definition of resident within the local tax jurisdictions as far as what is inserted into their legislation as to what constitutes a tax resident. And that is a vitally important definition. Secondly, the transactions must be between associated enterprises, and I'm going to deal with that a little later because we've seen some specific amendments as far as the South African legislation is concerned in this area. And then thirdly, the transactions must be at arm's length. So the arm's length principle is fundamental as far as the OECD TP guidelines are concerned. And that is the principle on which transfer pricing fundamentally is based. And to try to put that into context, arm's length means how would I transact if I were transacting with somebody who is independent and on that basis am setting my pricing, because by implication, that pricing should be at arm's length. So transfer pricing in the context of South Africa, legislative activity has been significant. The transfer pricing legislation has been in our Act for many, many years, but we've seen significant activity over the last 5 to 6 years. The fundamental or base legislation is set out in Section 31 of the South African Income Tax Act. This was significantly amended on the 1st of April of 2012, and that amendment was really in anticipation of that third bullet point, which was the signing on the 27th of January of 2016, the Multilateral Competent Authority Agreement on the exchange of country-by-country reports. And really that amendment in terms of the 1st of April 2012 was to look to align our legislation with international norms, to align our legislation better with the OECD guidelines, and then to ensure that we were in a position where we were able to comply with the multilateral agreements. The next step was the definition of international tax standard that was inserted into the Tax Administration Act in 2015. So as a result of all of these legislative changes and amendments, what we have in place is Section 31, which in principle applies the arm's length principle. We have what is referred to as the three-tier approach in place. That three-tier approach means that we consider country-by-country reports. We take into account whether or not we have obligations to present and prepare transfer pricing master files and transfer pricing local files. So when you hear about the three-tier approach, that is what is being referred to: CBC reporting or country-by-country reporting, master files, and local files. And then lastly, we have the regulations. There are 2 of those that were issued, and those set out the record and filing requirements from a South African perspective. So our overriding legislation is Section 31, and Section 31 defines what is referred to as an affected transaction. This is an important definition because if you don't have an affected transaction, by implication, Section 31 cannot apply. So an affected transaction is a transaction, operation, scheme, agreement, or understanding that directly or indirectly is entered into or affected between or for the benefit of either or both a South African resident and a non-resident. So this comes back to the transaction having to be cross-border between resident and non-resident. And then in terms of our definition, it requires that a connected person's relationship must be in place. And this is going to be one of the changes that I'm going to deal with a little later on. And then any term or condition must differ from those that exist if persons were transacting independently at arm's length. And if you tick all of that, then the Tax Act requires, so where a transaction is an affected transaction, taxable income or tax payable must be adjusted, applying the arm's length principle. And this is an extremely important aspect of Section 31 to keep in back of mind, must be adjusted means that the obligation is placed on the taxpayer to adjust in such a manner that the transactions are regarded as being at arm's length. And that is in terms of pricing, in terms of terms and conditions, etc. Then flowing from that, there is a potential secondary adjustment. So if there is an adjustment to the transfer pricing that is raised by SARS, there's then a follow-up secondary adjustment for any differential. And that difference from a corporate perspective is regarded as a dividend in specie. And for any person other than a corporate, it's regarded as a donation. We don't have specific thin capitalization rules. So thin capitalization rules deal specifically with interest deductibility. In South Africa's context, the arm's length principle applies in the purest sense of the form. So when looking at loans, you have to consider whether or not those loans, in terms of the terms and conditions and interest rates, potentially could have been obtained from an independent third party. That means that you need to consider credit ratings, and then flowing from that, you need to consider what the terms and conditions of those loans are. And then flowing from that, we have additional interest deduction rules, which may or may not apply, and those are set out in Section 23M. And we've seen some fairly large changes to Section 23M over the recent period, which I'm going to discuss. And then we currently have no safe harbor rules, and the Revenue Authority will not grant advanced pricing agreements, and they will not grant rulings specific to transfer pricing, which makes the environment somewhat difficult in terms of that onus resting on the taxpayer. So that onus resting on the taxpayer, and this is important, is that Section 31 is a taxing provision. So if there are adjustments made by SARS, the potential to exposure to the penalty and interest provisions is there because of the fact that it is regarded as a taxing provision within the Income Tax Act. So what are the local developments that we've seen within the South African legislation? The first one is a potentially significant one, in that it is an amendment that has become effective from the 1st of January of 2022. And that is an amendment to the definition of affected transaction. The definition as it previously stood, and my apologies, that's a typo there, was that a connected person's relationship must be in place. The amendment now reads, and those persons are connected persons or associated enterprises in relation to one another. So it adds into the South African terminology this term associated enterprise. That is defined to mean an associated enterprise as set out in Article 9 of the OECD Model Tax Convention. And the OECD Model Tax Convention is in essence a model double taxation treaty that is used by most tax jurisdictions in negotiating double taxation agreements with other jurisdictions. And the effect of this is that it aligns our legislation further with the OECD norms, because this is the terminology and definitions that are applied by the OECD. And it broadens the coverage beyond what are just connected persons as defined within the South African Income Tax Act. And to give an example of what that means is, if we look at an international organization that has registered in South Africa an external company, or what very often is referred to as a branch. Branch structures did not fall within the definition of a connected person because legally they one and the same person. and therefore don't fall within the definition of connected persons, and therefore did not fall within the provisions of Section 31. When we start looking at the definition of associated enterprise, that definition becomes so much broader that we now need to be very careful around our branch or external company structures, because these may very well now fall within, and in my view, do fall within the provisions of Section 31, which means that the provisions of the transfer pricing legislation will now start to apply to these types of structures. So that's just one example that needs to be considered. But external company or branch structures are quite common within South Africa. The next development has been the release by the South African Revenue Authority of a model for the establishment of APAs. They issued a discussion document in December of 2021. This was really following a draft discussion paper that they issued in 2020. And the fundamental objectives as set out in this discussion document is firstly that what they're seeking to achieve is alignment with international developments, and then secondly to try and provide clarity and certainty to taxpayers. It sets out a proposed process model, and it sets out draft legislation for advanced pricing agreements, and then indicates that any specific administrative aspects will be covered by ongoing releases in the Government Gazette. Setting up an APA unit, and SARS by their own admission in this discussion document, have massive challenges as far as resources and expertise is concerned in the transfer pricing space. This is not limited to SARS though. This is limited this applies to South Africa as a country, but is a worldwide challenge. So transfer pricing by nature is reasonably complex, and the people who are specialized and expert in this area are few and far between. And SARS at this point in time has a very small transfer pricing department. And the advanced pricing agreement unit is intended to be set up as a sideshow to that transfer pricing department, with the intention that it will ultimately be independent, supposedly. And I say supposedly because that's not always been our experience, but it should be independent from the existing transfer pricing department that is in place. So what is an APA? Just for those of you who are not too sure what I'm speaking about, in simple terms, what APA allows a taxpayer to do is, by following a set and defined process, make application to the South African Revenue Services, setting out the nature of its cross-border transactions, setting out how the pricing and or terms and conditions have been determined, and requesting that SARS make an assessment of those transactions and pricing and terms and conditions, and flowing from that assessment that SARS and the taxpayer then enter into a negotiation, after which they should be in a position to formulate an agreement, which will then fix the pricing, terms and conditions, etc., of the cross-border transactions that are being entered into. So once you're in a position where you've been able to reach an agreement and an APA has been issued, that puts you as a taxpayer into a position where you have certainty as to the fact that SARS will accept the mechanisms and pricing that is being applied. So very useful once they're in place, something that is used commonly in many jurisdictions around the world. So in my view, a good move from SARS. It's going to take some time. They're going to run some pilot projects before they start implementing this. But hopefully we'll see the implementation, the factual implementation in the near future, and this will then enable us to start to utilize this as a mechanism for firming up on whether or not they're happy with the pricing and terms and conditions of cross-border transactions that we're entering into. The next change has been the changes to the interest limitation rules, not directly related to Section 31, but as I say, a secondary limitation as far as setting out the rules on the deductibility of interest. As I indicated earlier, the current rules are set out in Section 23M of the Tax Act. The objective of Section 23M is to limit any excessive interest deductions. The fundamental requirements as set out in Section 23M are that interest is paid or accrued on a loan, which seems obvious. It has to be between a debtor and a creditor. A controlling relationship must exist between those two parties, and the creditor must not be subject to tax in South Africa. So those are the fundamentals that need to be met in order for Section 23M to apply. If that is the case, then the deductibility of the interest incurred is then limited in terms of a formula, which is basically linked to the repo rate in the manner in which it applies. The basis of that formula is such that when calculated, it will at worst achieve a position where the interest will be limited to a quantum of 40% of the what is referred to as adjusted taxable income of the taxpayer. And once you've done that calculation, there's a potential disallowance of all of or some of the interest that you've paid on these loans that meet the requirements of Section 23M. If that interest has been disallowed, you are able to carry that forward into future periods, run the calculation again, and then potentially claim that interest at a later date. And there's no limitation on the number of periods that you can carry that forward. In considering this, SARS has reviewed the current legislation. In particular, considering the release by the OECD G20 of the BEPS Action Plan 4. And as a result, we have just recently seen the Taxation Laws Amendment Act of 2021, which was promulgated on the 19th of January of 2022. And that contains some amendments to this section. So these amendments are as follows. Firstly, the interest definition in Section 23M has been amended to include payments under interest swap agreements, the finance cost element of lease agreements, taxable foreign exchange gains and losses in respect of that debt, that being the loans that fall within Section 23M, and amounts that are deemed interest in terms of Sharia compliant financing arrangements. So that interest definition has just been broadened a little bit. The deduction of interest expenditure has now been limited to 30% of adjusted taxable income. So it's a fixed percentage rather than the percentage calculation linked to the repo rate, and also puts us in a position where we're not going up to the 40% range. The interest limitation rules will now also apply to back-to-back loans. So these are loans where your creditor has lent money to a debtor. They are not in a controlling relationship, but the creditor originally sourced the funding from someone who was in a controlling relationship with the ultimate debtor. So that's what is meant by a back-to-back loan. The adjusted taxable income calculation must now include qualifying distributions received from a right. So some of the amendments, the biggest one is around this concept of interest not subject to tax. A common example of this is where you have withholdings tax on interest, which is then dropped as a result of a double taxation agreement to 0%. This would mean that the interest has not been subject to tax in South Africa. And that would then result in the Section 23M limitations applying. The rules have now been amended to include payments that do attract withholdings tax. And what they have now introduced into the legislation is where the withholdings tax rate is above 0%, but below the standard rate of 15%. So, for example, you have a double taxation agreement in place. You pay interest cross-border. It is subject to withholdings tax on interest. You look at the DTA, that says the withholdings tax on interest is reduced to 5%. Section 23M will now apply. And this is something that's very common. So this is something that we'll have to look at and will probably have the most immediate impact in practice in terms of the sort of day-to-day implications. So just keep this in mind. If you do have cross-border loans that are carrying interest, we need to consider this. Secondly, or rather, just in terms of a clarification, and this is on administrative issues, where you have withholdings taxes, you are supposed to put in place what are referred to as exemption declarations. So withholdings taxes apply to royalties, interest, and dividends. Reduced rates may apply in terms of the double taxation agreements in terms of these types of revenue streams. So specific to interest, as it stands now, the legislation allows a responsible person to withhold at a reduced rate in terms of the provisions of a double taxation agreement if you have received a declaration from the beneficial owner that specifies that the reduced rate applies. And if you don't have such a declaration, you are actually not allowed to apply the reduced rate. You have to apply the standard rate. Now, that same requirement was not in the Act specific to royalties and dividends. So this has now been amended and is now consistent across all types of revenue streams in terms of royalties, interest, and dividends. So again, just keep in mind, if you are making these types of payments, make sure you have these declarations in place if reduced rates apply. And if not, please put them in place. There is no obligation for you to file these with South African Revenue Services, but you are required to have them in the bottom drawer, for lack of a better way of putting it. Right. Then lastly, what's new internationally? And what we've seen is a fairly significant issuance of a document by the OECD setting out what is referred to as Pillar 1 and Pillar 2. Pillar 1 really looks to provide taxing rights to market jurisdictions based on a concept of residual profits that are earned by multinational groups. Currently, it is envisaged that this will only apply to multinational groups with annual global turnover greater than euro 20 billion. So it applies to very few and that are achieving a 10% profitability. But the concept of this is that it reallocates taxing rights over MNEs from home countries to where they have business activities and earn profits. So it starts to remove the concept of physical presence, which is something that we've always applied, and is really looking not only to regularize the normal tax environment, but looking to start thinking about the digital economy and how that gets taxed from an overall perspective. The second aspect, which is maybe a little bit more of application when we start looking at it from a general perspective, is the introduction of what is referred to as a global minimum corporate tax rate, which is at this point proposed at being at 15%. So what this effectively does is it starts to put a floor on competition over corporate income tax rates, where you have countries reducing corporate income tax rates in order to try and attract investment. And again, the intention is that this will apply to MNEs with turnover in excess of euro 750 million. But keep in mind, they're referring to groups. So, you might be a smaller subsidiary, but potentially this could apply. Now, these are proposed developments. They're not in place at this point in time. But what it's starting to move us away from potentially, and there's a lot of debate around this, is whether this starts to move us away from the arm's length principle and starts to move us into more formulaic type calculations as to how profits are shared between multinational entities within groups that are operating in multiple tax jurisdictions. So it's going to be an interesting development over the next few years. So very quickly, in conclusion, and I have popped over the time slightly, transfer pricing legislation and regulations do evolve on an ongoing basis. Revenue authorities are becoming more and more aggressive in this area. The rules and the legislation keep changing and will keep changing. And when we start looking at things like Pillar 1 and Pillar 2, those become fundamental. Internationally, it's moving fast. South Africa looks to adopt and align. So given that we've signed up in terms of the multilateral treaties, we're always looking to adopt and align, even though we are not a member of the OECD. And then from a SARS perspective, they have and do continue to gear up. They've got significant resource challenges. But what we are starting to see with them is firstly, that they are looking at gearing up in terms of their resource base, in terms of their skill sets. They're also starting to gear up quite significantly as far as their technology is concerned, their artificial intelligence, and their information gathering and data processing and data analytic capabilities. So as soon as they get themselves up to speed, we are going to see a lot more pressure in this environment. And you don't want to be behind the game, you'd rather want to be ahead of the game. So importantly, understand the requirements of the jurisdictions you're operating in. Make sure you've got proper advisors within those jurisdictions that are looking after you, and make sure you've got your transfer pricing stuff in place up front rather than trying to fix it after the fact. And then just some words of wisdom from Jean Stevens, our international CEO, and this refers to international accountancy, where her comment was that it has always been a fast-paced, exciting, and rewarding industry. As technical as it may seem, our industry is also very much a people business. But from a transfer pricing point of view, fast-paced, changing, that is a reality in terms of what we're working in. And it is something that you've got to keep up to speed with if you are operating cross-border. It is going to be really important. And as I say, I think our tax authority is going to start to get far more aggressive in this space. So that is me done for this morning. Thank you very much for your time and attention. If you do have any queries or questions, please feel free to contact me. My contact details are available on our website, and I'll be more than happy to respond.